I'm Rick Kaler. Thanks for joining me. It may be entertaining to watch Donald Trump point his finger and curtly say, "You're fired." But when a client says the same thing to me, it's not so funny. I'm especially not amused if a client fires me because their diversified portfolio is underperforming the U.S. stock market and they abandon the strategy. The result is often a financial travesty. The February issue of Inside Information, that's Bob Veris's financial newsletter, puts a name to this phenomenon: frame of reference risk. The term is used by Roger Gibson, who's Chief Investment Officer, and Christopher Sidoni, Director of Investment Research of Gibson Capital, they're out of Wexford, Pennsylvania. Veris reported on a presentation that they gave at the American Institute of CPA's Personal Financial Planning Conference in Las Vegas in January. Gibson describes frame of reference risk as clients' tendency to compare the performance of their diversified portfolios with current returns in the U.S. stock market. He points out, if the discrepancy gets too painful, they will fire you and abandon a diversified approach at the wrong time. Based on the emphasis the media gives the U.S. stock market, one could easily conclude U.S. stocks must be the largest, most important asset class in the world. Not at all. U.S. stocks represent less than 10% of the world's wealth and make up 10 to 20% of most diversified portfolios. Said another way, most diversified portfolios have 80 to 90% of their assets in something other than the U.S. stock market. Neither do U.S. stocks consistently produce the best returns. In the 70s, commodities dwarfed U.S. stock returns. In the 80s, international stocks led the way. In the 90s, U.S. stocks were the stars. And in the 2000s, the leader, well, was real estate. Yet most investors judge the performance of their diversified portfolio by U.S. stocks. They may compare the returns of a diversified portfolio with news reports about the S&P and the Dow, which together only include 530 companies. Between 1994 and 1999, the run-up of the dot-com years, Gibson's multi-asset class strategy delivered a 13.05% return, which paled in comparison to the U.S. market's 23.55%. He lost 1/3 of the assets he managed in 1999 as clients fired him. They abandoned their diversified investment strategy at just the wrong time to save themselves from the 2000 to 2002 U.S. stock market downturn. That's when real estate and commodities soared. Gibson's multi-class portfolio did 9.96% from 2000 to 2005 when U.S. stocks rang up losses of about -1% a year. This pattern, which is familiar to many financial planners, is the sad consequence of frame of reference risk. Another aspect of that risk is our human tendency to stay in a comfort zone where most of our neighbors are doing pretty much what we're doing. One client even told Gibson, and I quote, "I would rather follow an inferior strategy that wins when my friends are winning and loses when my friends are losing than follow a superior strategy that at times causes me to lose when they're winning." Unfortunately, this tendency can lead us into disasters. Diversified portfolios are once again underperforming the U.S. stock market. Predictably, an increasing number of investors are abandoning diversification, probably right in time to get nailed. Gibson and Sidoni's conclusion seems to be that educating clients to stay the course is a no-win game. In their view, advisors need to craft a less efficient, lower return, long-term strategy that clients will consistently follow, rather than a more efficient strategy that clients may abandon in midstream. While that view certainly seems pragmatic, I think it really misses the mark. Instead of dumbing down portfolios to match clients' dysfunctional money scripts, it'd be a better outcome if advisors concentrated on helping their clients uncover and modify those money scripts that are driving their self-sabotaging behaviors. This approach could keep clients from saying, "You're fired," at the wrong time for the wrong reasons. Thanks for joining me.